What's up? Mortgage Rate Monday. Today is August 15th. If you've been watching any of these videos, you'll know that there's really two drivers of mortgage rates right now. You got fear of recession and fear of inflation. Wednesday, inflation numbers came out and they were down, which should be good for rates, which they improved a little bit, but not near as much as you would have thought. And there's a couple reasons for that. It's kind of the game beneath the game, if you will. Rates are down about 0.1% across the board, so really not much. ARMs are actually up, which is odd. But anyway, so when rates were super low, the Federal Reserve was putting in policy what they call quantitative easing. Google that shit if you don't believe me. But what they do is they buy a bunch of bonds, like mortgage-backed securities specifically. They're buying a bunch of them, like $40 billion a month. That's billion with a B. And that's really what dropped rates down super low. Right now, what they're not really talking about in the news is a new policy, not new, but what they're doing now is called quantitative tightening, where essentially all of those billions and billions and billions of dollars of bonds that they bought during that time when rates were super low, now they're selling back and putting back into the market. So that's why, how do I want to say this? They have control. So they don't directly influence rates, but they do have some control. And a lot of this is happening exactly how they want it to happen. There's certain things out of their control, but there's a lot of things in their control. And that's one of them. So they're controlling the pace at which rates are going up right now because they can control how quickly or how slowly they put these bonds back into the marketplace. Because when they're buying a lot of them, that increases the price of the bond, right? Because there's less supply out there, so there's more supply demand type stuff. So when the bond goes up, rates go down. When the bonds prices go down, rates go up. So what they're doing when they sell a bunch of them back into the marketplace, they're putting in more supply, bringing prices down. Rates are going up. So that's pretty much what's going on right now. You're not really going to see a bunch of that in the headlines. I mean, like I said, you can Google quantitative tightening and see for yourself if you really want to nerd out on that. But at the end of the day, we're going to kind of be back and forth here for a while. I don't think we're going to see a big jump either way. The number one thing to look out for is the Federal Reserve meeting in September. That's when they're going to announce their overnight borrowing rate hike, which is what they've been talking about. Like when they said we're going to raise rates either 0.75% or 0.5%, that's what they've been talking about. If rates only go up 0.5%, that's already priced into the market, so we probably won't see any change in mortgage rates there. If it goes up 0.75% to try to control inflation more, then we're probably going to see a jump in mortgage rates, fairly quickly after that. So that's just something to keep an eye on. Like I said, in the meantime, if you got loans closing here fairly quick, I'd probably lock just to be safe. Anything that's going to be, 30, 45 days, if you're just kind of like, shopping around a little bit, you could probably float those and be okay. I don't think either way you're going to, kill a deal. But I mean, obviously if you got really close debt to income tolerances, I'm trying not to get super technical because like I just make this for the average person, not really like people that can't say words like me. But yeah, that's pretty much it for this Monday. I will see you guys next week.